In the alternate version of exercise 12-11, we're asked to prepare the statement of cash flow for year ended June 30th, 2016 for Ichabod Company, and it also notes that in the operating section, we want to use the indirect method. We have the information we need here, that we have our income statement for the latest year end. We also have comparative balance sheets for information balances on our assets, liabilities, and equity for both our year ended 2015 and also 2016. In addition, there's some other information that we'll need in our statement of cash flow. One is that the company retired a $25,000 note payable at its carrying value in exchange for cash. The only items affecting retained earnings are net income and cash dividends paid. C says new equipment is acquired for $60,100. D indicates they received cash for sale of equipment that had cost $48,800 and that yielded a gain of $2,400. In addition, prepaid expenses and wages payable relate to other expenses on the income statement, and all purchases and sales of merchandise, inventory, and credit. So here's all the information we need in order to move forward with our statement of cash flow. So let's go ahead and do that. Keep in mind, we've got three major sections on our statement of cash flow, or major activity areas. Going to be operating, investing, and financing. We're going to start at the top with our operating. And of course, again, we're going to use the indirect method. So we're going to start with net income, our accrual-based net income, and we're going to reconcile that to our cash basis cash flow from operating activities. Our net income on our income statement is $84,000, so we'll go ahead and transfer that there. Then keep in mind we've got a number of adjustments in order to reconcile that net income to operating cash flow. If you recall, we've got to look at any non-cash expense or revenues listed on our income statement and reverse those. In particular, our first one is going to be depreciation expense. Recall that's a non-cash expense, and since it previously subtracted from net income as an expense, we're going to add it back as $57,800. We'll scan through here again. We've also got one remaining non-cash expense or revenue, and that's going to be gain on sale of equipment. Previously, it added to net income. Keep in mind, the cash flow from the sale of equipment is actually going to show up in our investing section. So we need to reverse out or subtract out our $2,400 gain from our operating section. So that helps us out so far with our income statement. I will note later on in the process, if you want to just write a quick note down, we'll need our net income again. That's going to be $84,000, and we'll need to make note of our depreciation expense, and that's $57,800. Just from the constraints of the video and not to crowd too much on our screen, I won't pull up the income statement again, but you may just jot down those figures. Now I'm going to continue moving forward on our operating section. And our next initiative that we're going to do is look at any non-cash current assets and current liabilities and look at the change, if any, in those accounts and understand what cash impact that we should show in our operating section. So I'm going to start out with accounts receivable. That's the first non-cash current asset. And as you can see, is accounts receivable increases from $51,600 in 2015 to $69,700. If you recall, an increase is going to be shown as a deduction on our operating section. In fact, the total dollar value of that increase is $18,100, so we'll show a subtraction of $18,100 related to that increase in accounts receivable. Our next non-cash current asset is going to be inventory. Inventory decreases from $95,800. If we subtract out $66,100, which is a 2016 balance, that's a total decrease of $29,700 from 2015 to 2016. If you recall, a decrease of a current asset is shown as an increase in our operating section to reconcile net income. Our next item is going to be prepaid expenses. That's also a current asset. It also is going to decline from $6,200 in 2015 to $4,300 in 2016. That's a $1,900 decrease. Decreases in current assets are shown as an increase in our operating cash flow. So that's going to be all of our current assets because equipment, remember, is going to be a long-term asset. So now we're going to move down and identify any current liabilities, any non-cash current liabilities. That's going to be, first one's going to be accounts payable. It's going to decrease from $32,300 down to $26,100. That's a $6,200 decrease. Remember, decreases in current liabilities are shown as decreases in order to reconcile our net income. Our next current liability is going to be wages payable. We declined from $17,000 in 2015 to $7,500 in 2016. That's a $9,500 decrease between years. And again, that's going to be shown as a decline or subtraction in our operating activities section. We next have income taxes payable. It also is going to decrease from $3,800 in 2015 to $2,100 in 2016. That's going to be a $1,700 decrease, which again is going to be shown as a subtraction because it's a current liability. So if we go through here and just simply tally up all our adjustments, $57,800 for depreciation expense, a decrease of $2,400 for our gain on sale of equipment, $18,100 subtracted for our increase in AR, $29,700 added for a decrease in inventory, along with $1,900 added for a decrease in prepaid expenses. In addition, we've got a subtraction of $6,200 for a decrease in accounts payable, $9,500 for a decrease in wages payable, and last but not least is a $1,700 decrease in income taxes payable. If we add up all those increases and decreases, it is a net increase of $51,500. If we add that net increase of $51,500 to our net income of $84,000, we get net cash provided by operating activities of $135,500. It's provided by operating activities because it's an inflow. If it had been a negative number here and our adjustment had been our subtraction had been greater than our net income figure, it would have been net cash used by operating activities. But again, this is a significant inflow related to operating activities. So that's just our first section. Hang with me. We'll keep going, plugging away one by one. Our next section is going to be our investing activities. You'll notice, don't get too scared, some amounts disappeared on our comparative balance sheet. To make it easier, I wanted to go ahead and strike out those current assets and current liabilities that we've already taken care of to make it a little bit easier to narrow in on what we need to do next. Recall that investing activities usually are related to long-term assets. Well, it just happens that this particular company is fairly easy. The only long-term asset it has is equipment and the accumulated depreciation related to that equipment. Now you could look at this account and say, well, we went from 2015 having a $115,000 balance to 2016 having a $126,300 balance. I guess we bought equipment for the difference. We'll just show that as a subtraction. But the problem is, we might have bought some equipment, which should show as an outflow, and we might have also sold some equipment, which should show as an inflow if there's any cash related to that. And we have to distinguish the inflows from the outflows in our investing section. So we're going to look at our additional information in order to see if it's helpful. Well, C in our original information seems like it's going to be helpful. It indicates that new equipment is acquired for $60,100. That's going to appear under investing activity. Cash paid for equipment, it's an outflow, so it shows as a negative $60,100 because it's outflow of cash. Well, that's not the end of it because unfortunately that doesn't totally explain the change from $115,000 to $126,300. Now, I don't have to do the exact math, but if I add $60,100 to $115,000, I know it's significantly more than $126,300. So we must have sold some equipment also. So we need to factor in any cash related to that sale. So let's keep plugging away with our additional information. One additional piece of information indicates that the company received cash for the sale of equipment that had originally cost $48,800, yielding a gain of $2,400. Well, that needs to be factored in here because there's going to be a cash inflow related to that sale. But they're being a little bit extra tricky and they're not giving us that cash amount directly. But keep in mind, you can use the knowledge that you learned from our plan asset chapter in order to back in what the cash impacts. So don't worry, we'll keep plugging away at this. So I'm going to look at and dissect my equipment account first, and then my accumulated depreciation account in order to finally work towards the amount of cash that was received related to this equipment that was sold at a gain. So if I put our equipment account in a T account, keep in mind the beginning balance was $115,000, so I'll show it on the left-hand side as a debit. Also, I know according to C that we acquired equipment for the cost of $60,100. That would have been a debit to the equipment account, correct? I also know that the ending balance is $126,300, so I would show that as an ending debit balance. The problem is if I add $115,000 and $60,100, I sure don't come up with $126,300, but I can back into and know that I would have needed to credit the equipment account. If I look at the difference between $115,000 and $60,100 and $126,300, I would have had to credit the equipment account for $48,800. Now, that's the cost of the equipment removed. That still doesn't answer the question of the cash, but that's one piece of information that we need is what was the cost. I also need to dissect accumulated depreciation. Keep in mind it indicates accumulated depreciation had a credit balance of $10,700 at the beginning of, at the end of 2015. We also know, remember how I indicated to you to jot down somewhere that depreciation expense on our income statement was $57,800? This is that point at which we're going to use that information. When we recorded depreciation expense as a debit for $57,800, we would have also credited accumulated depreciation for the same amount. So we're starting to build it here. We can also note that our ending balance in 2016 is a credit balance of $28,600. Again, if I add up the beginning balance of $10,700 to the additional depreciation of $57,800, it certainly doesn't come to the credit balance of $28,600. But keep in mind, we disposed of an asset that had a cost of $48,800. Certainly, it also had some accumulated depreciation. We would have needed to debit accumulated depreciation by $39,900 in order to go from our beginning balance, our additional depreciation expense, to our ending credit balance of $28,600. That would have been the debit that we needed to do. Again, from that sale of equipment, I'm still not telling you directly the amount of cash, but I do need this information. It's helpful to have the cost of $48,800, and it's helpful also to have the accumulated depreciation removed of $39,900. Why is that? Take the cost of $48,800. Remember, if we subtract accumulated depreciation of $39,900, that gets us something called book value. And if I take $48,800 minus $39,900, I get a book value of $8,900. I know you're still saying that's not cash. Another step and we'll get there. Keep in mind, this indicates that the company received a gain on that sale of $2,400. Well, think about how you calculate a gain in a disposal of a fixed asset like this piece of equipment. In order for a gain to have been recorded, it would have meant that the company would have received more cash than what it gave up, which is book value. So if we add together the gain on sale of equipment to the book value, again, because it's a gain, if it would have been a loss, we would have needed to subtract it from it. Because it's a gain, if we add it to the book value, we back into the fact the cash we received must have been $11,300. I know a lot of work to get to that figure, but you know what? Sometimes that's what you have to do. And you can expect you might see things like this creep up both on your homework and also on your exam. So be familiar with it. So finally, getting back to our investing section, all that work to determine that the cash received from the sale of equipment is $11,300. A lot of work, right? So I can start to total up. I can get rid of my accumulated depreciation accounts because I've already factored those in. Those are the only long-term asset accounts that I need to factor in. So if I look at my total net cash for investing activities, I have an inflow of $11,300. From that, I'll subtract $60,100 cash paid for equipment, and I get an overall negative investing number of $48,800. Because it's a negative number, an outflow, it's going to be called net cash used by investing activities. Now, just one more section, so don't worry, we're plugging and chugging and moving ahead with it. So we've got financing. So again, let's kind of look at where we're at. We've only got a few items left: long-term notes payable, common stock, and retained earnings. Those are long-term liabilities and equity-related accounts that will affect financing. So let's take a look at our notes payable and see any information. We can see that it decreased from $71,000 in 2015 at the end to $46,000 in 2016, but we really need to dissect. You know, we could assume that that was a pay down of $25,000, but we need to read through our additional notes to make sure there isn't more than one activity related to notes payable. It does indicate that $25,000 note payable is retired at its $25,000 carrying value in exchange for cash. What that just means is it was retired and they paid out the $25,000. So in our financing section, we're going to show an outflow or a negative amount, cash paid to retire bonds, a negative amount of $25,000. So we can go ahead and strike that one out. Our next one is going to be common stock. Now, not seeing any additional notes of, buybacks of common stock or any additional information related to common stock, we'll assume the only thing we have related to common stock is that the company sold additional stock for cash. Again, not seeing any additional information telling us to the contrary. So the company started with an ending balance in 2015 of $183,000. It increased to $232,000, then to 2016. Again, not seeing any information to the contrary, we'll assume they sold stock for cash in the amount of the difference, and that difference is $49,000. Again, $232,000, $183,000. The difference is an inflow of $49,000. So one more step and we're almost there. Now we've got to take into account retained earnings. Now the last step's going to be a little bit tricky, and we've got another note that talks about retained earnings. What it mentioned is the only changes affecting retained earnings are net income and cash dividends paid. And if you think back to your statement of retained earnings, recall if you start with your beginning balance of retained earnings, $7,900, you add to it your net income or take away your net loss, the only thing else typically that you need to factor in for most of the common companies we've looked at is any dividends. We would subtract those out in order to arrive at ending retained earnings. So we know three pieces of that information. We're not told directly what cash dividends are. Again, another tricky one, but we can figure it out with the information we need. Again, start with the beginning balance of retained earnings, $7,900, listed on our balance sheet. Add to it our net income off of our income statement of $84,000. Remember I said this would be cluttered up if I pulled up the income statement too. So I didn't want to do that, but our net income on our income statement was $84,000. If we add that to our beginning balance, all we need to do is subtract out our dividends in order to arrive at our ending balance and retained earnings of $94,900. If I do a little algebra and move things around and get dividends on the one side and all the rest of the numbers on the other side, that means cash dividends must have been $67,000. So again, be prepared that you might have to make that calculation. So cash dividends is an outflow in our financing section of a negative $67,000. If I look at, again, strike that out, that's all I have left on my comparative balance sheet. Our financing activities start with $49,000 inflow from a stock issuance, $25,000 outflow from retiring bonds, $67,000 outflow for cash payment for dividends. If I add those up, I have an overall outflow of $43,000. Again, because it's an outflow, it's going to be called net cash used by financing activities. So I've got a major portion of my statement of cash flow already done. I've got the cash impact of my significant operating, investing, and financing activities. That's one major part of my statement of cash flow. I will note that if I ask questions like, for example, what's the largest source overall of the three categories? What's the largest source of cash overall? An inflow of $135,500, an outflow of $48,800, and an outflow of $43,000. Well, the true winner here, the only inflow it happens to be, is going to be our operating activities. So the largest source of cash for this company is operating activities. And that's a really good sign for a company. It's, at the beginning, some companies are going to struggle. This may be negative. They may rely on borrowings, or issuing additional equity. This company seems to be pretty stable and generating most of its cash from operating. And that's what you'd expect from a more stable, maybe mature company. What's the largest use of cash? Well, financing and investing are pretty darn close for here, but our largest use overall category is going to be net cash used by investing activities, and largely that comes about because they look like they're expanding somewhat by buying equipment. But again, largest use of cash is going to be investing activities. This is only one major portion of the statement of cash flow. We want to also look at adding these items up, an inflow of $135,500, an outflow from investing of $48,800, and an outflow from financing of $43,000 leaves us an overall net increase in cash of $43,700. Again, major portion coming in is operating. We also want to prove out and reconcile and make sure that $43,700 explains the difference in our cash from 2015 to 2016. So let's notate our beginning balance of cash on June 30th, or not beginning balance, but ending balance of cash on June 30th, 2015 is going to be $57,100 from our comparative balance sheet. If we add that to our increase in cash of $43,700, then we do balance out to a June 30th, 2016 balance of $100,800. So that's the other portion, is we just want to make sure too that we reconcile our cash balance here. Now, one last item that I'm going to go ahead and list is we're asked to do the ratio for the chapter. What's cash flow on total assets ratio for fiscal year 2016 only? Keep in mind that that ratio is going to be operating cash flows, which is going to be our $135,500, divided by average total assets. So again, take $135,500, not total cash flows, but just operating cash flows, divided by average total assets. Keep in mind that that's going to be $315,000 for 2015 plus $338,600 for 2016. We'll add those two together and divide it by 2 in order to get an average. So it's going to be $135,500 divided by $326,800 is going to give us a cash flow on total assets ratio of 41.5%. And that's a pretty strong amount of cash from operations related to our overall asset base.